story, and we are joined by Sanlisiwe Gancho, who is an economist at Liberty Life, and she's with me here. Thank you very much for coming.
Thank you for inviting me.
All right, let's start with the extensive analysis of the developments and the build-up to the cut on the forecast of global economic factors. Let's start with the United States. What really happened? Let's unpack that so that people can be able to understand the influences of this economic powerhouse.
So the United States, being the biggest economy in the world, felt a decline in their first quarter economic growth. So much like it's always said, when there's a flu in the United States, the whole world catches a cold. So that's a major determinant for the IMF to reduce that forecast. That will essentially create the trend and the theme for the rest of the world.
Mm-hmm. So at the beginning of the year, the climatic conditions, the disturbances at the port had an influence on that. Now, we have been hearing talks of the Fed intending to increase interest rates.
So the IMF has actually recommended to the Fed to hold interest rates and up until their recommendation is about the first half of next year, because they want to try and give the United States a chance to grow to that 3.3% that you mentioned in your intro into next year. Mm-hmm. So that how that translates, it gives the world a little bit of a breather, going through the motions of a downward sort of trend with where the economic growth is concerned.
And then moving abroad, China, there was a very dramatic sell of 30% plummet of the whole stock exchange there. Tell us about how those dynamics unfolded.
So how those dynamics unfold within China, being a global player, it affects the emerging markets. So depending on that particular emerging market and their exposure to China, they would have felt the effects of an odd 30% plummet in the past 30 days, the past month. So that's translated into China really looking into the regulatory reforms mm-hmm. Where their financial markets are concerned, but where a country like South Africa would, which is a developing economy, they would be looking more to the Eurozone, where that's the main trading partner. But I'm pretty sure you're going to get to that.
Yeah, but then my understanding was that, was this not a recipe for disaster to have investors borrowing money from government to buy shares and pay back the money through the profits that they would make from the shares? But when the shares were performing bad, they didn't have the money to pay back the government. Was this not flawed at the beginning? It
could have been flawed from the beginning, but much like the principles within investing, you have to take a bit of risk to try and calculate, even if, unfortunately, the calculation doesn't go very well, a calculated risk into the kind of return that they would have wanted. But like you mentioned in your intro, China has sort of rebalanced since this 30-day stint of really plummeting in the stocks.
All right, now coming to the Eurozone, with Greece being the major player of negative news coming out of that country, how does that play out?
So that plays out in this particular country, within that region, sort of facing problems, while the rest of the Eurozone is kind of looking at them in that you're bringing the entire Eurozone economy down. So it's the one bad apple within the basket of fruit. Mm-hmm. That's what it is. It's a very unfortunate situation that the Greeks find themselves in, looking at trying to avoid a third bailout, which spoils the economic potential within that region. And the ripple effect would be South Africa being a main trading partner, already ailing in our own economic growth. So this doesn't bring much good news to us domestically.
Well, I don't intend to put you on the hot spot, but looking at the way things are going in Greece, there's promise that perhaps the proposals for cash for aid that could finally be presented by Sunday. A resolution could be reached. We heard Angela Merkel saying that the door is still open and Greece may not get out of the Eurozone. What's your prediction?
Look, I think the major institutions I think the viewer should really take heed of the IMF and the European Central Bank, abbreviated as the ECB, as perhaps maybe meeting Greece halfway. I think that would be a fair sort of prediction. Those major institutions can't leave a country that is in this grouping called the Eurozone, this grouping called the Euro, in complete destitute. But depending on funds availability, I think they will meet them halfway.
I was listening to a debate where some analysts were saying that if the ECB meets Greece halfway, then Spain would say, you never met us halfway. What about us? So is that not actually setting a precedent?
Not necessarily, because you can't compare apples and apples. Each economy is very different. So the decision at a regulatory level, at a decision-making level with your powers that be, that are your politicians and your heads of your major institutions, would look at the country's debt levels first of all, and how the economy, or the potential of the economy performing with aid, without aid. Those are the important questions that are asked. So it's not apples. It's not comparing apples to apples. It's apples and oranges.
Okay, well, let's take all the fruits and make a fruit salad. But for now, thank you very much for talking to us.
You're welcome.
Okay, ladies and gentlemen, we are speaking to Sanelisiwe Kancho, who is an economist with Liberty Live, giving us an analysis of the cast in global economic growth forecast by the International Monetary Fund.